Okay, so what we're going to do now is carry on with our discussion about interest rates. And the next one is forward interest rates. This is by far the most complicated type of interest rate, but they're awfully useful for certain types of modeling, especially, again, as I've mentioned several times, derivatives, because the structure of the cash flows often takes place over several periods in the future. And we have to have a way of assigning a value to each one. And so we often find it more convenient to use forward interest rates rather than spot interest rates. And certainly we don't use yields unless we're dealing with bonds. So what are forward rates of interest? Well, it's an interesting idea. It basically refers to the idea that you could, in theory, negotiate a loan at a rate of interest that is determined to apply to a future period in time. So in other words, let me just show you, I think I have a graph here. If I don't, let me just draw one real fast. Imagine you walked into a bank and said something like this. Here's today, and here's 1 year from now, and here's 2 years from now. And you say to them, well, you know what, I'd like to borrow money for 1 year, but not until next year. So in other words, the loan would apply over this period. The question is, what rate of interest would they charge you? Well, whatever rate it is the 1 year forward rate. And then because it starts in a year, we then go on to describe it as 1 year forward. So with a forward rate of interest, you have to describe two different time periods: the length of time that the loan will last and the time at which it starts in the future. So if you had something like this, so your loan is meant to take place over this period, that would be a 2-year rate, 1 year forward. Meaning that the rate itself lasts for 2 years, but then it doesn't start for another year. So you probably wonder, well, when would this ever actually happen? Well, it's sometimes done in order to lock in rates at which we can borrow in the future. So this proves to be awfully convenient for when we're trying to value cash flows that take place at different points in time down the road. So how are they calculated? Well, let's do this numerical example. We have a bank that pays a 5% rate of interest for 1 year time deposits and 6% for 2 years. Okay, so think of them as CDs. A CD is a certificate of deposit. It lasts for a specific length of time. And in exchange for leaving your money there for a fixed length of time, you get a higher rate of interest than you would with a traditional savings account. So here, the bank is saying, right, if you leave your money here for 1 year, guaranteed, we'll give you 5%. If you can leave it here for 2 years, guaranteed, we can give you 6%. So on the timeline, it would look like this. And by the way, this is actually a spot rate, so we'll call it S1. And then the 2-year rate, which is actually a 2-year spot rate, would be 6%. Okay. So now let's assume somebody decides that they're going to put $1,000 in the 2-year CD. In 2 years, they'll have $123.60 because you're multiplying 1,000 times 1.06 times 1.06. Okay, in other words, we have 6%. And the principal that we invest is $1,000. At the end of the first year, we have 1,060. At the end of the second year, we start with the result of the previous year. In other words, we start with 1,000. At the end of the first year, we add another 6% to that 1,000 to bring us up to 1,060. In the second year, we're applying that 1.06 or 1 plus 6% to 1,060. So this time, the amount we end up with is 1123.60. Okay. Now, by the way, although we didn't mention this in the slides, I just want you to see something interesting here. At the end of the 2 years, we have $123.60 worth of total interest. You can tell because the final value of this deposit is 1123.60. The $1,000 is the original deposit or principal. So we must have 123.60, which we'll call total interest. Now, of this, $120 is referred to as simple interest. Now, that means interest on the original principal that we deposited. And you can multiply that out. You can just notice that it's the principal times the rate times the time. So the rest of that interest, the remaining 360, is referred to as compound interest. Which is interest on interest. In other words, it's interest on previously earned interest. In this case, that would mean that the 6% that we received in the second year, based on that $60 of interest we earned in the first year, that's where it's coming from. Okay, so that remaining 360 is compound interest. Now, what's interesting about these two is that the simple interest grows at a linear rate. And the compound interest, well, you can see it grows very rapidly in later years. It's more or less, or it's approaching very quickly exponential growth. So in the short run, there's not very much compound interest in your bank account, but if you leave your money there long enough, eventually the compound interest will be greater than the simple interest. Okay, so that's kind of the secret to saving for retirement, by the way, starting early, because after 30, 40 years, you'll have mostly compound interest. But anyway, so getting back to forward rates, what we want to know is there a rate of interest that would equalize the returns to doing two things? First, investing your money in the 2-year CD, or investing your money in the 1-year CD and then rolling it over into another 1-year CD. So that rate is referred to as a forward rate because it starts in the future. In fact, in this case, this is a 1-year rate, 1 year forward. And the logic behind it is that if I invest my money at the 2-year rate for 2 years, it will match up with investing at the 1-year rate and then putting the proceeds into another account, which earns the forward rate 1 year forward. Okay. So in other words, algebraically, that means that and by the way, the notation that we're going to use here is this. So in other words, if I wrote something like this would be a 3-year rate, 2 years forward. In other words, it covers the period from 2 to 5. So it's actually a 3-year rate, but it starts in 2 years, which is why it matures in year 5. Okay, so we have to get used to this notation. It's always going to tell us when do we start and when do we finish. 2 to 5 means starting in year 2, ending in year 5, which implies that it's a 3-year forward rate. Okay, so but for this simple case, we can solve now for F12 by rearranging this algebraically. And you'll see that what we've got is 1 plus S2 squared over 1 plus S2, S1. Okay, so if we have a term structure of interest rates where we know the spot rates, we can easily turn around and calculate the implied forward rates. So if we go back to the example we had last time, uh, no, I mean like this one right here. The last time we had different examples, but let's go back to this one. Given that S1 is 5%, and S2 is 6%, the implied forward rate here, this diagram, we can calculate it very easily now. Let's bring this back down here so we can once again visualize what we're doing. And we'll see that there is indeed one unique rate that will equalize the two investments. Okay, so we'll end up with so that means that F12 is just equal to this ratio minus, no, sorry, that one is not squared. -1. All right, so if you pop that into your calculator, it's almost exactly 7%. Okay, so that means that investing for 2 years will provide the same return as investing for 1 year and then rolling over the proceeds for another year at 7%. And so that's what this forward rate is telling us. It's the rate that equalizes the two investments. All right. So again, with the notation, we're going to use FT comma T. I couldn't remember. This is the notation used by Hull's book. Let me change that right here, just so it's consistent. So he's using lowercase t to indicate the starting point of this rate and the capital T to represent the maturity date. Okay. All right. And then the difference between them is the actual length of time over which the forward rate applies. Okay. So like in here, in this case, it would be 3. All right. So here's the explanation for all that. So here's 2 comma 3. This is a rate that starts in 2 years and matures in 3 years. So it's a 1-year rate. 3.7 starts in 3 years, matures 7 years in year 7, which means it's a 4-year forward rate, 3 years forward. Now this one, now here's where we have to watch it. A little trickiness here. If the forward rate starts today, then it is in fact a spot rate. So, in other words, the forward rate 0 1 means it starts today and matures a year later. So therefore, it is actually itself a spot rate. Okay, so by definition, a forward rate that starts immediately is a spot rate. And that means that, yeah, for example, S2 would be F0 comma 2. We'll see why that matters later on. So here we have a different example. We have the 1 year spot rate is 3%, the 2 year spot rate is 4%. Um, what equalizes the two? Well, we go through the same calculations and we ended up with 5%. Okay. So it's just kind of a ridiculous coincidence that so far we've had two cases where the forward rate was an even number, like 7 or 5%. It usually doesn't work out that way. All right. So this is the one we just worked on. You recognize it. Now this is what I was referring to before. Remember, we had all these examples. We built up this little chart with spot and forward rates, or actually, it was yields and spot rates. This we did the other day. I think there might be a chart here that I can just, here it is, just copy it. So what we're going to do now is add the implied forward rates. Uh, yeah, I just want to change the format. That would look really terrible. There we go. Now that's much better. Okay. So we have room here to fill in our calculations for the forward rate that corresponds to these numbers. So remember, we started with the yield curve. That came from the markets. We calculated the spot rates. Okay. And then we're now going to add one more column here. The first one is the spot rate. In other words, for the first row, we're going to have this one. But now it's going to change. And then down here, we'll have F2 comma 3. So these are all 1 year rates. And what they're doing is equalizing the returns between years 1 and 2 and 2 and 3. Okay, so let's do that. The first one we don't have to worry about. F12 will be this. Okay, so let's figure that one out. Okay, so it's about 6.03, or of course 6.03%. Right? So that, oh, let's leave the extra one in there. Okay, we don't want to overround it. Since we're using three play, all right, yeah, let's do it this way. Okay, and then for 2, 3, we're seeing it's S3 cubed and S2 squared. Why is that? Because here's what you're actually doing. You're taking this to your spot rate and you're equalizing the returns between buying the 2 years or investing in the 2 year spot rate for 2 years and then rolling it over in here 1 more year. And then we want to equalize that with the 3 year spot rate. So altogether, this is a 3 year investment any way you look at it. So the numerator is has an exponent of 3 and the denominator is 2. So when we plug these in, we'll get, so S3 is from the other day, 6.041. And S2 is 5.514. All right, so this is going to give us approximately 7.10%, 7.103. Okay, 7.103. All right, so now it turns out that there's a pretty interesting relationship that's going on here. And I'll show it to you with some graphs. Yeah, let me just show you quickly what we're seeing here. If the yield curve is upward sloping, spot curve, as we've already seen, is above it, and then so is the forward curve. Okay. If the yield curve is sloping downward, then it works in reverse. Now, of course, that's probably a little exaggerated, but you get the idea. They're all going down together, although the forward rate is going more quickly. And then if the yield curve is flat, then they're all going to be flat. Now, of course, if you have other, this looks great for the very simple yield curve shapes. If the yield curve has bumps and it goes up and down and it flattens out, things like that, then this relationship will be very different. But when it's just a continuously increasing curve, then this is what the relationship looks like, or if it's continuously decreasing or flat. For others, it's going to be a lot messier. Now, this formula is designed to show us any type of forward rate we might run into. So let me add this here. It's a more general formula. The ones we looked at so far, mainly forward rate had a maturity of 1 year, but that's not necessarily always going to be the case. What do we do with those cases? For example, the 2 year rate 1 year forward, meaning this one, do this. In other words, this is a 2-year forward rate and it starts in 1 year because we're comparing the 1-year spot rate and the 3-year spot rate. So that means what we have here is that F1, 3 equals the difference between these two is 2, 1 plus S3 cubed over 1 plus S1 to the first, all minus 1. Okay, so that's what that's trying to tell us. When you have 1-year rates, you don't need this root, but when you have 2 or more, you do. Okay, so that's why this is here to help us remember how to calculate all the different possible forward rates. It's simpler when it's the forward rate has a maturity of 1 year, but beyond that, you really do need this formula. So what they're doing here is saying, well, let's go back to the example that we've been working with, and you'll recognize the spot rates in our chart. Let's go grab that thing again and confirm this. Here we go. So for this example, F1, 3 would be this. And so we'd ultimately end up with it's 656. All right. Yeah. Okay, great. Now you can um, calculate a spot rate directly from forward rates. In other words, you can calculate obviously forward rates from spot rates. But if there's some reason why you need to do the opposite, this is how it would be done. It's actually a sequence of forward rates. Each spot rate can be thought of as a sequence of forward rates. Just so, for example, let's see. Oh, here we go. So let's say I want to know how S3 looks. Okay. So in other words, you're going along the sequence of 1-year forward rates. Although remember, this one is actually S1, but we can think of it as a special type of forward rate. So we can write it in this general form: 1 plus F01 times 1 plus F12 times F1 plus F23. The product of those, we raise it to the 1/3 power because there's 3 of them, and then we subtract the 1. Now, of course, this just falls right into place from the definitions we had earlier. So here we've got copied the 3 forward rates from the chart, and you see that we do in fact that does bring us back to S3 equals 0.06041 right there. Perfect. This is not nearly as common, though. Normally, you're taking the spot rates and turning them into forward rates, but there might be times when this is handy. All right, so that's for the time being, that'll do for our discussion about forward rates. Now we're going to introduce discount factors, which are a little bit different because these are all fractions of 1. And a discount rate, or discount factor, they're sometimes called a fraction of 1 that represents present value of receiving a dollar in T years. So what does that mean? Let's find out. So the formula looks like this. All right, so we'll start with our first example, S1, which you remember is 5%. So you plug that into your calculator, you'll get 0.95238. So what that means, the present value means this. Um, having a dollar in 1 year is equivalent to receiving 0.9523, about 95 cents or so today. Okay, so this number is known as the present value of a dollar received in 1 year. And then we can claim $1 is the future value of 0.95238 invested today at 5%. Okay. So the two are equivalent to each other as far as investments go. Having a 95.238 cents now is the same thing as having a dollar next year, because if you invest the 95.238 cents today, you'll have a dollar next year. Now, how about the D2? Now, keep in mind here, the dollar is being received in 2 years, so that reduces the value of this discount factor. So S2 is, once again, I have to go back and find it. Oh, there it is, 0.05514. All right, let's see what that turns out to be. All right, 8982. Okay, so I mean, you get the idea here. It means that having a dollar now, or sorry, having a dollar in 2 years is equivalent to having 0.8982, about 89.8 cents today. So they're equal to each other in the sense that if I invest this money, if I receive the 89.82 today and invest it at the rate 5.514, in 2 years, I'll have exactly $1. All right. And then we might as well do D3 while we're at it. All right. So D3, as you can probably guess, so S3 was, I've already forgotten, 6.041. And that's 83.86. Actually, the discount factor doesn't have a dollar sign. That's our interpretation of it. The discount factor is just a fraction. Let me get that out of there. All right, 83.86. Okay, so you get the idea. That means that having a dollar in 3 years is the same as having 83.86 cents today. Okay, so so then here I brought them all together so you can see them all. You can see these three, they're all interest rates. These are discount factors. These are all fractions of one. If I were to plot these against time, they would look something like this. All right, so the curve is downward sloping, but it's not linear. It's actually convex to the origin, meaning that the first derivative is negative, the second derivative is positive throughout. Now, we could actually, as it turns out, because of the relationship with spot rates, you could in principle calculate the forward rates directly from the discount factors, but you don't see that very often. I mean, it can be done. We're not going to focus on that here, but you should probably be aware that, if you do go ahead and do this, and here's some examples, and you'll see it will work out to the exact same numbers. Now, I mentioned this before at the beginning that all four of these measures, yields, spot rates, forward rates, and discount factors, even though the numbers are different, they're actually giving us the same information and presented in a different way. And so to prove that, we're going to take a 3-year, 6% coupon bond, and we're going to calculate its price using all four measures. So with the yields, the 3-year yield, if you remember, is 6%. Let's go get that chart for a second and confirm that. Right. So what you're doing is you're discounting those cash flows with the 3-year yield, and you do end up with $1,000. With spot rates, it's 1 plus S1, then we have 1 plus S2 squared, 1 plus S3 cubed. And yet, even though the numbers are different, you can see it still adds up to 1,000. All right, now how about forward rates? Now this is where it gets a little messy. The first one is discounted by 1 plus the F01, which is a spot rate. Here we need a string of forward rates, 1 plus F01 times 1 plus F12. And then for the last one, we need 1 plus F01, 1 plus F12, and 1 plus F23. So it's a bit messier, but you can see we do end up with the same result. And remember, because we proved earlier that this is nothing but S3 cubed, and this is nothing but 1 plus S2 squared. And of course, this is 1 plus S. All right. And then finally, the discount factors, this is D1, D2, D3. Look how easy that is. It's like you're basically using a weighted average of these discount factors to come up with your result. You're multiplying each cash flow by the appropriate discount factor. And so you end up once again with $1,000. So that proves that these numbers in these charts are all basically the same information presented in a different way. It would be like having a chart with prices for a good in 4 different currencies. It's going to be the same any way you look at it. All right, so that's chapter 3 in a nutshell. Now for 4, we're going to do something a little different. We're going to move our attention to not so much the math, but the price, the securities themselves that we're going to be pricing. So section 4 introduces us to the first set of derivative securities that we'll be looking at. Specifically, we'll be looking at what are called forward contracts and futures contracts. So keep in mind that derivative securities are all designed to do one thing. Not that they have to be used this way, but this is what they're really intended for. These are securities whose value is derived from an underlying asset. So that's where the name comes from. They are highly useful for hedging purposes, which means, of course, they're used to reduce the risk of holding financial assets. But they can also be used for speculation, which of course means gambling. On the future values of financial assets in order to make profits. So you can gamble, you can roll the dice and say, I think gold is going up in the future. And now, of course, you can buy the gold and hopefully sell it at a profit. What's different here is that derivative securities are highly leveraged so that buying a derivative means that the investor, or I should say speculator, can make multiple times his or her initial investment if all goes well, but can also lose multiple times his or her initial investment if all does not go well. There have been horror stories throughout the last 40, 50 years of individuals and companies who lost enormous sums of money because they didn't really understand how these derivatives work. This is a quick historical footnote here. Barings Bank, which no longer exists, was put out of business and this is in the late 90s, when one of its traders, futures traders in Singapore, lost over $1 billion. Speculating on the K225, which is the Japanese stock market. Yeah, that takes a lot of. It's not easy to lose $1 billion, but it took him like 3 or 4 months to do this. The reason why this happened is because he was in Singapore. The bank is in London. He's in Singapore. Unfortunately, he's been put in charge of both the front and the back office, which means he's not only the trader, the front office, but he's the back office, which means he's recording all the trades. And so what he of course did was, as he lost money, he lied about his positions to his employers and kept insisting that he was making money when he was getting clobbered. And eventually he couldn't cover his losses any longer. And oh my God, the bank had to be sold to ING for £1 or something like that. So it was a very sad story. And in fact, this is one of those rare cases where this trader actually went to jail for a while. That you don't see that every time. Often they just get fined or they get fired or whatever. This guy did actually do jail time because of the way he deceived his employers. He actually committed fraud, as a matter of fact. So it can happen if you're not careful, if you don't know what you're doing. But if you manage your risk well, I mean, the idea here is that wasn't what these were meant for in the first place. The idea is to make it easier to hedge your risks. And so that's what they're really mainly intended for. Whether they're used that way or not is a different question. So anyway, what is a forward contract? Well, it's an agreement. It's very simple. It's an agreement to buy or sell an asset in the future at a price that is specified today. This takes place between two counterparties, maybe a corporate customer and a bank, and so then they can negotiate any terms that they want. For example, let's just make up a quick example of this. Um, as an example, suppose that a jewelry manufacturer will need to buy, let's say, 100 ounces of gold on September 1st. The current price is, let's say, $3,300 an ounce. Manufacturer is, of course, exposed to the risk that the price will rise by September 1st. Now, what can they do about it? Well, they can buy the gold now, but this means tying up funds that could have been used for another purpose or borrowing and paying interest until September. That's kind of awkward. Okay. September 1st. In other words, you don't want to get involved with buying it now because it's a lot of money. You're talking about 100 times $3,300. That's 33, 30, $330,000. What if they don't have the money now, and they have to borrow it from a bank? And then there's the other thing too with gold. It has to be stored somewhere safely, and that could end up being costly. So rather than doing that, the other possibility is they can simply wait until September 1st and hope for the best. But that's kind of risky. Hope for the best. But this means they're greatly exposed to risk. Another option or another possibility is to do this, is to enter into a forward contract to buy 100 ounces of gold on September 1st. And let's just say that that the price agreed to is $3,400 an ounce. Okay, so in other words, the jewelry manufacturer has entered into a contract with a counterparty. Most likely it'll be an investment bank to buy gold, 100 ounces of gold on September 1st for $3,400 an ounce. By the way, there's some terminology we need to go over here. The current price of 3,300 per ounce is known as the spot price, and the price agreed to in the contract is known as the forward price. Okay, so the distinction between the two is when is it going to be delivered? The spot price refers to the cost of buying gold for immediate delivery, and the forward price is the price or the cost of buying gold for delivery in the future. Um, the jewelry manufacturer is said to have a long forward position as the buyer. The counterparty, investment bank that is said to have a short forward position as the seller. Now, the good thing about this is that the jewelry manufacturer has eliminated all price risk with this contract. They've locked in the price at 3,400. That's it. They don't have to worry about the market price when September 1st rolls around. It makes no difference whatsoever what the market price is. We're getting it for 3,400 an ounce because that's what we agreed to. The only drawback is that if the price of gold falls, which it could, the manufacturer will not be able to save money by buying at the lower price. They're committed to buying it at 3,400. And that's that. Okay. So in other words, you get rid of all your risk, but in exchange for that, you also give it the opportunity to save money if the price goes down. Okay. So you can see what a great, easy way to hedge risk. Just enter into a contract, you agree to take delivery in the future for a fixed price, no more price risk. Okay. Now, if a gold mining company is worried about prices falling, it can enter into a short forward position to sell gold at the forward price of, let's say, we'll keep the same example, 3,400 per ounce on September 1st. And same thing. In other words, the price is locked in. That's it. We don't have to worry about it. The price risk is gone. Okay. But then this company will have short forward position, and the counterparty, whoever that happens to be, will have a long forward position. You always have to have, of course, a buyer and a seller. So you have to get together with somebody who's agreeing to this. So one of the key advantages to a forward contract is its flexibility. Two sides negotiate anything. Whoops. The asset to be delivered, the delivery date, price of the asset, etc. So in other words, it's completely flexible. You agree. If you need the gold at a different time, or if you need not as many ounces, or what if you need a different metal that's not so heavily traded, like platinum, let's say. Um, no problem. As long as you can find a counterparty out there somewhere, you can negotiate anything you want. So you can see there's an enormous amount of flexibility here. Another advantage is that there's no price there's no price associated with this contract. The only thing that might happen is if you're doing this with an investment bank, they might charge you a commission or a fee or something, but there is no actual price as such. It's just an agreement. Okay. Or maybe the lawyers will charge a fee or something, but there, for all practical purposes, you're just saying, let's do this, and that's the end of it. And again, as we saw, the drawback is that it is impossible to take advantage of any favorable changes, let's say, in market conditions. Okay, so in other words, if you're locking in the price of gold that you're buying and the price goes up, that's you've hedged yourself. But if the price goes down, you cannot save any money. Okay, so you're locking yourself in. That's what the whole point of it is. So these contracts are actually very heavily. There's a lot of volume in these contracts. Let's put it that way. Just because you can see there's so much flexibility here, it will be a great way to negotiate or enter some kind of agreement in which you can lock in whatever it is you need to do in the future. Now, because these are private arrangements, though, you can't actually sell your contract to somebody else if you change your mind. So another drawback is that this is a legally binding agreement and cannot be easily terminated, let's say. In other words, if I suddenly realize, hey, I don't really need that much gold, well, I'm committing myself to buying it. Unless the counterparty is agreeable and we decide to put an end to the contract, that's it. We have to go through with it. So there's good things and bad things about this. Uh, so, like any other security. Now, here's an interesting result. How do you know? And if you notice in my example, I assumed that the spot price was 34,300. Just 3,400. Where did that come from? Well, I made it up in that case, but in general, this is the formula that we'll use. And now, by the way, this assumes, well, first of all, let's remind ourselves, what do these variables mean? F, of course, is the forward price. This is the spot price. T is the time to delivery of the asset. Okay, in other words, if it's a 6-month contract, that would be half a year. And then R is the risk-free rate of interest, which means the yield on a treasury security with the same maturity as this contract. Now, we're going to see why this is the case very soon. But in order to explain this properly, we need to introduce an incredibly important concept called arbitrage. And we're going to have to spend a lot of time with this, so we don't want to rush through it. But we can prove that this is the correct price, or this is the correct forward price. Now, I'm going to put an important side note here. This formula only applies if the underlying asset does not provide any income to the owner. And of course, that would be true with gold. Okay, you don't get interest payments or you don't get dividends or anything like that. If there is some form of income being paid to the owner, the formula has to be adjusted, of course. And we will see how that works. Okay, we're going to see what happens or why this formula holds by introducing this insanely important concept of arbitrage. And then we're going to see how we have to adjust this formula when there is income. For example, if it's not gold, but let's say it's let's say it's a foreign currency where you could earn the foreign rate of interest by holding it. Then you have to make adjustments to that formula. Okay. Now, I do want to mention here that in this chapter, we're going to also look at futures contracts, which have a lot of similarities, but there's a lot of really important differences. So this is where we're headed. Now, since arbitrage is so vitally important, I think it might be a good idea to start that discussion with a new session. So in the meantime, we'll stop it right here. And then when the next time we'll discuss arbitrage, we'll discuss this formula, and then we'll introduce forward futures contracts. Okay. So we'll do all that next time, and I'll see you then.